pamozi ya bambo, pamozi tinga kwanise. Tisebenze pamozi ya mai, matenda tinga silize. Tisebenze pamozi ya bambo, pamozi tinga kwanise. As we adapt to the new normal, together we can call you in a solo. The farmers and the traders must sell like a bully.
TNT Zambia kumanja osagwila kumenso. Maka mwe balimi mwali ba essential.
Mulyesha ziko.
Chachina.
Mwaole meke seko.
Mukala le plasi konsefe na kumishi. Amafunde wale sosa tuyasungishe.
Tikwirizane tinkale panja imbozi. I corona sinafwele kuchita vingazi. I corona ilibendiwe fama. I corona ilibe I corona ilibendine leader. Anza kontrolola no. Corona ilibendine teacher. Corona ilibendine doctor. Corona ilibendine police. Anza kontrolola.
Tisebenze pamozi ya mai, matenda tinga silize. Tisebenze pamozi ya bambo, pamozi tinga kwanise. Tisebenze pamozi ya mai, matenda tinga silize. Tisebenze pamozi ya bambo, pamozi tinga kwanise.
Lile mule afu abalimi mwibalabako. Kwa bula bena nefya kulianga tafibako. TNT konkanya pofe kula isunga. Na mafunde basa sokula ya konka. COVID-19 kutuwa ichimpe tubike pofeka haiting.
Uko kufamu valani na mamaski. Kusamba kumanja ndiye ngani. Alelelelelele. Uko kufamu valani na mamaski. Kusamba kumanja ndiye ngani. Lelelelelele.
This message has been powered by the Center for Trade Policy and Development, CTPD, with support from the Open Society Initiative in Southern Africa, OSISA, OSISA.
Welcome to Unscripted TV program here at Movie TV. I'm your host and presenter, Mr. Boyd Blair, who is head of research at the Center for Trade Policy and Development. And you have had a series of a number of programs from our side, CTPD. And today we discuss yet a very special program that affects all of us. So today we discuss demystifying interest rates. And I think these are articles that the center has been able to produce in the past 2 weeks. So basically, break down what interest rates are and how they affect us. So in terms of the process, we're going to look at what interest rates are. So what are the different definitions around interest rates? And further on, we'll look at the different types of interest rates that you are able to familiarize yourself and basically relate to that. And further on, we'll look at the role of interest rates in the economy. And when we talk about interest rates in the economy, we are talking about, interest rates and how they affect you, whether you are a business or whether you are an individual. So basically, those are the issues around today's discussion. And further on, we'll also look at monetary policy. How does it play out as, an overall interest rate measure in the economy? And I'm sure you have heard in the media most of the times that, the central bank would be able to revise interest rates either upwards or downwards. And these are some of the discussions we'll actually be talking about. Then lastly, we'll also focus on the process of recapitalization. How can that help in reducing interest rate? As we heard, the government proposed recapitalization as a measure. So we are going to look into detail to just discuss the feasibility of the same, whether that is possible. Ladies and gentlemen, I welcome you once again to this program. So just to start, definitely there are so many definitions probably you've heard around interest rates. In other contexts, some people will tell you that interest rate is the rent that you pay for the money that you actually borrow. Some people would also tell you that interest rate is the price of money. So when you actually buy money. And I'm sure you know now that people buy money. So when you go to the commercial bank or a financial institution, what you're basically doing is buying money. And what you are charged in terms of the price is what we refer to as interest rate. So if we are discussing issues around our communities that we can relate, we know about loan sharks or people who do kaloba, those who kongwesha kaloba. So those are some of the people that we know, and they will charge interest rate. So that interest rate will be discussed in this respect, and that's just basically the definition. So we are saying that when you're talking about interest rates, you need to recognize the fact that there are principal amounts that are involved, and the principal amount is that amount which you actually borrow. But what you pay over and above is your interest rates. For example, if you borrowed 100 kwacha, and then you know, at the end of the loan tenure, you are charged 110. It means that the 10 kwacha would be the interest amount. So how was it calculated? It was basically 10% of you know, the principal, the 100. So it's very imperative as we discuss interest rates to also look at the various you know, terms that are very beneficial. So we have key terms like I've just mentioned. We're talking about a principal amount. The principal amount is the money that you actually walk away with, and it's the amount that we use to actually charge that interest rate. Okay, so we just delve a little bit further in discussing, you know, the different types of interest rates. Okay, so we have what are known as fixed rates. Okay, so you can go to a financial institution and they can tell you that you will be charged a fixed rate. What does that mean? So a fixed rate basically means that it does not change over time or over the period of you know, the contract that you sign or the tenure for that particular financial instrument. But when I say financial instrument, I mean to say you know, such a product as a loan, such a product as a bond. Pretty much these are some of the, you know, financial instruments that you may want to actually know. So basically that's a fixed rate. It does not change over time. Then we have a different type of rate, and this particular type is called the variable rate. So when it's variable, we're just basically saying that it's adjustable and it is flexible, and this is what is actually common amongst ourselves when we borrow money from the financial institutions. So we tend to have you know, this type of you know, interest rates when we are discussing issues around you know, short-term you know, investments or short-term loans that are probably given to us. But when we discuss the other part, which we started with earlier, which is a fixed rate, it tends to actually you know, be applied on long-term you know, loans and investments such as mortgages. So pretty much those are some of the aspects. But when we talk about calculation of the actual interest rates, which we also recognize as a type of interest rates, we have what is known as a simple interest rate. So when you talk about simple interest rate, we're just basically saying this interest will be charged on principal, like I earlier alluded. So the kind of computation I'd made earlier refers to simple interest. So a simple interest, basically, our dear viewers, is that it speaks around just being charged some form of you know, return on your principal. But then there is this particular type, which probably you've heard again. It is called compound interest. So what is compound interest? It basically speaks to the computational differentials. So it actually speaks around how we calculate. So when you are doing a compound rate, we are considering both the principal and the interest in calculating for the subsequent years that come through. For instance, if you borrowed your 100 kwacha, okay, so you'll be charged maybe, for instance, 10% interest, and that 10% interest at the end of the period, let's say 1 year, you end up with 110 in terms of what you pay. Okay, then on the other hand, it's like when we get into 2 years, you get to be charged you know, 121. So the 11 is coming from the fact that you are no longer charged on the 100, which was the principal previously, but you are also charged on the component of interest, which is 110. So you end up paying an extra 11 kwacha, so that you have the ultimate total interest of 21. That's after 2 years. So pretty much these are some of the things. But we won't delve into the issues of calculations, because this is not the essence of this platform, but obviously just to give some light there. And then we also talk about some special type of interest. I'm sure you've heard of what are known as prime rates. So what are prime rates? So these are also types of interest rates, but mostly commercial banks or financial institutions who tend to use them on the much credit worth customers. So there are those customers who are much more credit worth, they have a lot of money, so it becomes very easy actually to negotiate your interest rate. So if you thought that interest rates were fixed, okay, so some people actually get to negotiate their way into a better rate. Okay, so we'll discuss the technicalities of interest rates and whether they are good enough or whether they are a good investment for ourselves or not. Okay, so then the other way is to look at what are known as discount rates. So the Bank of Zambia does report a discount rate. So the discount rate basically is the rate that you would definitely pay if you're a financial institution and then you borrow money from the central bank. Okay, so pretty much those are also types of interest rates. We do have in this country what are known as overnight lending rates. Overnight lending rates are basically rates charged amongst banks when they lend to each other. By the way, banks do lend to each other, every day. There are times that one particular bank may fail to meet the requirements in terms of, the statutory requirements, such as the statutory reserve ratio, which is basically a proportion of deposits that should be actually submitted to the central bank or kept in the vault, at least for the purposes of submission to the central bank. So those requirements have to be met daily, and if the particular bank, probably in the course of doing business for that particular day, they end up, exhausting at least most of the resources, they can have recourse to another bank which can give them money. So what they pay there is an overnight rate or an interbank sort of rate. So in general, all these rates actually feed into what you pay because you need to realize that just like in the goods market, in the commodities market, we are able to sell products. And when we sell products, we do order, these products from somewhere, if it's wholesale, and then you take them to retail. So if you want to think of it, that is a way you can actually look at it. So when you see a commercial bank or a financial institution get money from, the central bank or from depositors, they are sort of actually getting money from the wholesale side. But when they come to you to give you a loan, it is the retail side. So pretty much the same concepts that we see. But I think it would be very imperative to note that, you see, there are many factors that influence interest rates in this country, the same interest rates we are talking about. And of essence, later on, we shall definitely touch on the issue of the monetary policy, which I mentioned. And I've intentionally not decided to capture it among these different types of interest rates that I've put across. And just to let you know, our dear viewers, that there are so many types of interest rates in the world. Okay, so pretty much these are the key ones that we may need to focus on. But I just, for starters, and just provide basic knowledge to our listeners, maybe who are starting in terms of understanding these kind of concepts. So it's just good that we leave it at that. But later on, we'll be able to discuss issues around the monetary policy rate and how it is impactful in the economy. So pretty much that's what we have to do. But then let's delve a little bit deeper in discussing some of the factors that influence interest rates in this country. Okay, so what you have to know is that there are two key things that have been captured initially when interest rates were being actually designed. So the first aspect was what we call the real rate of interest. So the real rate of interest is one which does not actually include inflation in its computation. Then we also have to consider an aspect around the nominal rate. The nominal rate is what is quoted, or what you see quoted by the banks. So the nominal rate usually includes a component of inflation in it. Okay, so I will also be able to explain why am I discussing issues around components of this, components of that. I think it's an idea of just getting to appreciate that when you are perceiving that inflation will be high and you have some sort of resources, in this case money, you would want to actually ensure that the person you are giving money pays you a premium for the money that you are actually giving him, because you are losing out on a number of things. And these things could be opportunities that may come. You may lose an opportunity because you gave someone money. Let's take, for instance, if I had a 25,000 kwacha and someone comes through and then they get 25,000 kwacha and I charge them maybe a low rate of interest. The following day, they decide to bring the money. And if I did not compute my returns very well, I may not be able to cover for the time difference. And this time difference speaks to what we refer to in finance as the time value of money. So that money is much more worth today than actually tomorrow. Why is that? It's because tomorrow is uncertain. Tomorrow we don't know what happens. And so when we discuss interest rates, our dear viewers, it is mostly around capturing the components of risks that are inherent in this particular financial instruments. In this case, we are discussing a loan. So what would happen in this case is that the first, like we've discussed, is the real rate of interest. It is the basic rate that you can charge someone. And I'll just speak back from what we discussed in terms of the types of interest rate. A discount rate is actually one of the basic rate. And then the monetary policy rate is one of the basic rate. It also forms the basis for charging interest rates, and we will discuss that as we move forward. So the prime rate also can be used. The overnight rate can also be used. So these are some of the interest rates. Sometimes when we want to calculate real interest rates, we want to proxy it or to actually measure it up with the real rate of interest. We want to measure it up with the yield on a treasury bill. Okay, and the reason is that the yield on a treasury bill happens to be a bit, fair in terms of computation, because it is a risk-free sort of, return. So when you invest in a government security, the return that you get from there is actually considered to be risk-free. But the question is it really risk-free? Okay, so those are, again, discussions for other days. But the truth really is that it provides the lowest kind of, risk in terms of return. Now, going further, one of the most problematic, aspect in terms of computation of interest rates is inflation itself. And I was just explaining before that the time value of money mostly accounts for inflation. So why are you paying, or why are you going to charge someone who is borrowing your money higher? It's because you are accounting for the inflation component, which might affect your resources the following day if inflation changes. So you are going to charge them what is known as a premium. So it's a payment over and above what the person would have paid, and it covers for that risk. Now, what are some of these types of risk? So these types of risk will form a basis for our discussion, and in terms of additional factors that influence interest rates. So the second one is default. Okay, so when we talk about default, we speak around, the failure to repay. Okay, so when you borrow money, there are chances that you may not be able to actually pay. Or when you lend out money to someone, there are chances that the person will not also be able to actually pay your money. So that risk of failure to pay is known as default risk. Our dear viewers, it's very imperative that I can liken this situation to even a country. A country do have to borrow resources once in a while, and we have seen many times that our government has also borrowed. It borrows on a continuous basis, and so far there was some form of default risk on the part of government where we have failed to pay to repayments in terms of the bond. So a bond is also a debt instrument where interest rate is also charged on the same, just as an example. Okay, so pretty much default is one of the factors. So when lending institutions get to see that, okay, the person that we are dealing with has high risk in terms of default, they will charge you a high return. I was previously talking about, a situation where we have prime rates being charged on much credit worth individuals. Now, these rates tend to be better if you are going to invest with an institution and you are considered to be on the prime side, or a big guy or a big corporation that pumps in quite substantial amounts of money, you definitely get to receive a high return if you are saving with a financial institution. So what we are basically saying at that point is an appreciation that default is a good measure of how interest rates should be priced. So the more credit worth you are, okay, the less interest rates you should pay. And the less credit worth you are, the more you should pay. That's actually also working as a disincentive for the financial institution in terms of you lending from them. You feel discouraged because the interest rates could be charged very high. And I think it's a good measure on the part of financial institution. It protects them. It provides some form of a safety net. Okay, so going forward, we also discuss one of the very key influences of interest rates, and that is our very own exchange rate. So exchange rate translations can actually affect the money that we do borrow. So in terms of interest rates, let's play it out. So when you borrow money, it depends on the jurisdictions where money has been borrowed. Sometimes because of exchange rate translation, there is need for you to actually commit to the risk of exchange rate. So to protect yourself, because there was a movement in exchange rate, you need to provide a premium, and that premium will sort of push interest rates a little bit higher. And when they push that higher, it's a financial institution protecting themselves from that situation. Going forward, dear viewers, we also look at liquidity. So liquidity is one aspect which is also very key in determining interest rate. So if you're looking at liquidity itself, you find a situation where if you get money from me, what are you doing? You're basically borrowing in this case, and you're just saying, okay, fine, I'm taking money from this gentleman and I want to use it because for me it's much more important. But then what are you leaving me with? You're leaving me with nothing. So when you leave me with nothing, again, there's a risk that if I want to meet my short-term needs, I may not be able to because you took my money away. So how do I cover myself for that? I charge you what is called a liquidity risk premium, and that liquidity risk premium increases how much actually you pay on the interest rates. Okay, going further, we also do have what is known as maturity as a factor or a risk that influences interest rates. So how does that play out? So when you're talking about maturity, the longer you get resources or the longer you borrow, the more you have to definitely pay in terms of interest rate. Why? Because the risk is actually much more. The unforeseeable future is more uncertain than what we can see today, what we can see just next the following day, and so forth. So pretty much the longer you get, in terms of the longer you borrow, the more likely it is that you also pay a high interest rate. So that is what speaks to maturity. Okay, so pretty much these are some of the key factors, dear viewers, that you may need to consider, and many more that actually actually considered. I just want to emphasize one key aspect. Today we are talking about the cost of doing business. So financial institutions and lending institutions who give us these resources where interest rates are charged basically cry foul when it comes to the cost of doing business. So the cost of doing business is really very high on their part as they record. So pretty much that also feeds into the charge for interest rates. And of course the quest to just have higher margins, given the economic circumstances, everyday things are evolving, so people have to cover up to a number of risks. So those are some of the things that may be considered. Okay, so moving on, we are going to just touch issues or touch base with the benefit or the role that interest rates actually play in the economy. Okay, so pretty much there are so many roles that interest rates play. So we'll try as much as possible to touch base with quite a number of these aspects. So beginning, maybe we want to just say that interest rates would have a connection with inflation. And that's a sort of reason why the central bank does track, inflation using interest rates. And interest rates, in this case, we are referring to the policy rate. And these are issues I will be able to discuss. And at this moment, before we get into the next phase of the program, we go for a commercial break. Welcome back. So we were talking about demystifying interest rates on this TV show, which is called Unscripted TV program. So today we are looking at interest rates for those that have just joined us, and we have discussed quite a number of things. So we are moving forward and discussing what are the roles of interest rates, or what role does interest rate play in the economy. So basically, I will look at a few macroeconomic issues. By macroeconomic issues, just for a layman, we're referring to such economic variables as inflation, exchange rate, unemployment, gross domestic product, or GDP. So just to touch base. So interest rates are actually very key in terms of influencing other macroeconomic variables. And I was just saying that this is a reason why the central bank, our Bank of Zambia, tracks inflation using interest rates. And I'll play out some of the relationships. And in discussing the role that interest rates play in the economy, I would also want to touch an aspect of the transmission channels of monetary policy. How does interest rate transmit throughout the economy, so that we can see this sort of benefit? But then there's something we also need to preempt. When we are looking at interest rates in this respect, monetary policy is basically an action by the central bank to actually target money supply in the economy, or to move money supply, to adjust the level of money supply using different tools of monetary policy. This could be what we refer as open market operations, and these are just the buying and selling of government securities happening almost all the time in the securities market. Then we also have the policy rate, which is used, and that is what we report as a prime rate. We have what is known as the statutory reserve ratio, basically speaking to the proportion of deposits that borrowers actually do, that lenders do have to set aside given what has come through. So those pretty much are some of the traditional tools of monetary policy. We're not discussing that, but it was just important that we set base and just try to highlight some of these key things for our understanding. Our focus today would be on the monetary policy rate. And just for your information, the monetary policy rate will be announced in this week on Wednesday by the central bank governor, and he will set course. And at the end of this program, I'll be able to share a bit of some highlights in terms of what we expect as the Center for Trade Policy and Development. So pretty much what we get to see is that there is a relationship again between interest rates and investments. And I think that's a very, very important aspect. And that speaks to why when interest rates are very high in the economy, it becomes a disincentive for borrowers, individuals, households to actually go to the financial institutions to get money, because it becomes more expensive for them and that they cannot afford the high interest rates. So pretty much that speaks. Now, how does that transmit through the economy? If we have fewer people borrowing, then we have less investments. And then we have less investments, that means that, the economy can't grow. So pretty much that's the idea. So even in setting the monetary policy rate, what the central bank is just trying to do is to ensure that there is enough space for the economy to expand further. And by the way, the economy can overheat just like your car. So pretty much we don't want a situation where the economy is overheating and we are trying to expand further. So that's where you see the government or through the central bank will try to sort of use interest rates to actually adjust by contracting the economy so that it actually doesn't get to expand. So pretty much that's what happens. So in terms of the exchange rate, there's a relationship again between interest rates and exchange rate. Now, this is a very interesting part which you may actually get to know. And I want to just speak around, do you think that interest rates are always bad when they are high? So this is a question that we are answering now, and we are saying that it's not all the time that when interest rates are high we should cry. In fact, it's an opportunity for you to look for money and invest, and that investment will actually speak around you getting the higher returns. It only becomes bad when you are actually you are the one who is actually borrowing, so you get to pay much more. So the relationship between interest rate and exchange rate mostly is seen from the external sector side. An economy being open as ours, the Zambian economy, then we get to see that there will be people who actually would be interested in our financial instruments here in the country when interest rates are high. Okay, so in a situation where interest rates are very high in the country, and also given, of course, there's a condition, it's not automatic, given the levels of inflation within that country, you tend to see more people coming into the country to actually, supply money. So in supplying money, they're basically investing, looking forward to that high interest rate that probably us as borrowers will be scared of. So the best, like I said, you just switch gears and become an investor in that case. So when they come, they have to invest in kwacha-denominated instruments, and it's at that point that our currency gets to appreciate. And that's why you find that when the Bank of Zambia would like to control inflation, you see they actually increase interest rates. Okay, they will signal an increase in interest rates. And when they want to also control the volatility of the currency, they also increase interest rates. And people will be surprised and saying, but why should they do that? But basically that's how economies play out, and it's issues of business cycles, and also looking at potential and ability for the economy to still take in pressure. Because if the economy can reduce interest rates, okay, it means that a number of people will be borrowing, and if a number of people are borrowing, that increases aggregate demand. And the more demand we have that we can't contain, given the levels of supply, the more likely it is that we create inflationary pressures. So pretty much those are some of the issues that we have to focus on. So then the other aspect in terms of interest rates do have a negative relationship with bonds. So in the bond market, again, we get to see the impact of interest rates in terms of the overall perspective. Okay, pretty much those are some of the things. But I would just reserve time that we can have probably, these discussions as we do the phone-in program. But I will continue and just move to the last part so I can finish up the first part of the program. Okay, so in terms of interest rates, I just want to emphasize on households. How do they affect you? Now, we are speaking to the monetary policy rate. So there's a situation where if the central bank adjusts this particular interest rate called the monetary policy rate upwards, it speaks to an increase in overall interest rates in the economy. So if you have a loan, it means that you have to pay more. But for your own information, we discussed earlier in our program that we have what are known as fixed rates, we have what are known as variable rates. And that will apply only on those that have contracted on variable rates. It means that whenever the central bank is trying to increase interest rates, that will impact on your loan obligation. And many of you have seen a situation where you have been servicing this loan for many years, and we have heard talks that, no, we have the banks charging us interest rates, high interest rates, and then our loans are not finishing. It's not that the loans are not finishing. What the banks basically do is that whenever that variability happens, they adjust your interest rates upwards. But then they'll also be looking at the debt service ratio. So if you don't fall within the debt service ratio that is stipulated, they'll have to extend your loan so that you can have a breather in terms of repayment. Because what the banks don't want to do is to lump you high interest rates that you may fail to pay. So they will rather spread your loans that you start sort of paying smaller components of it. So pretty much that's how it plays out. Okay, so going to the last part in terms of the first segment. Now, there is a proposal by government that recapitalization can actually reduce interest rates. Okay, so I'll just speak also around this issue. Yes, the link that we establish around recapitalization and interest rates is mostly around, money supply in the economy, or having institutions that are able to supply money. Now, there are various forms of recapitalization, especially for banks, that you may need to know. For instance, we have an example where, the bank can actually get infusion of money from the bank, from the government. How does that play out? So the government does issue bonds, and these bonds are subscribed to by financial institutions. And these resources that are gotten by the government are then given back to the bank in terms of equity. But then that has a restriction, because when you are playing out in terms of getting more equity in a financial institution or in any institution, you have to play to the rules of the stock market. Okay, so it's not just like, no, because we are government, we are going to infuse money and then we are going to have an equity ownership. No, there is a proportion of equity, and you also have to play out to the stock market rules unless you actually want to take over the bank. And I think that's not the spirit of our government, which has been encouraging a lot in terms of investment. So pretty much that's the only way. But what we are saying is that that proposal may actually have challenges, given that it is not at the free will of the government to actually, just pump money into the economy. And worse still, if we were to pump money even in these institutions, the question that you'll be asking is that where is their self-sustainability? It means that they are not sustainable in the first place. So we can give them money today, but tomorrow they may fail to actually live up to expectation, because the business model is not actually based on organic growth. So pretty much these are some of the things that will cause interest rates not to reduce, recapitalization not to reduce interest in that space. So pretty much those are arguments, and again we can discuss these as we open the phone line. So I'll just go straight into opening the phone line. So the number is actually displayed on the screen, is 0764250055. So I'll be opening the phone line so that you can call in, so that we can have a chat or two on this matter. Demystifying interest rates with Mr. Boyd Mlea, Head of Research at the Center for Trade Policy and Development. Okay, so while we sort out some technical issues, I will still be able to just highlight some of the, important aspects that we basically need to know around interest rates. Now, when you look at the way organizations work in terms of central banks, different central banks do use different rates. So we have, for example, the government of Canada uses the policy rate just like ourselves. Oh, by the way, the policy rate was only introduced in April of 2012, so it's something very new in terms of using it as a prime rate for the economy, or as an interest rate, which basically drives the overall interest rates in the economy. Okay, I think we are back, so let me just get through to the number. The number is 0764250055. So if you have any callers on the line, please feel free, the line is open. Okay, so as we still wait for our callers, we just need to discuss further on. I was talking about the different policy rates or different base rates that are used by different countries. We do have the United States, which is actually sort of a good model also, using what is known as the federal funds rate in terms of determining its monetary policy. So these are sort of examples that we have. So this is a particular interest rate that financial institutions can actually be charged when they borrow from the central bank or when they borrow from each other. So basically, it speaks to the discount rate. So if the central bank increases these particular interest rates for the commercial banks, it speaks to a high interest also on the borrowers. So pretty much that has an impact in terms of how much investment is done in the economy and how much consumption is done in the economy, and so forth. And I just want to speak around consumption. Sometimes it has been deemed to be to be a bad thing to consume. Dear viewers, consumption for the economy is good for economic growth. So it depends on what you are consuming on. Because imagine if people are not consuming your goods and services or whatever you actually do sell, then it becomes a problem. So clearly it may speak to less economic activity because we cannot create jobs and so forth. All these things are actually coming from interest rates. So interest rates actually speaks around a very key variable, okay, that actually has to be looked at. In fact, even when we are making decisions in various spaces, we need to actually use these parameters. And I think we want to see more of political leaders also taking up the mantle to discuss key variables like interest rates. For the most part, we discuss other rates like inflation, we talk about economic growth and so forth. But there is a lot of ingredients that comes to the growth of the economy. And one of the serious ingredients to the growth is this particular macroeconomic indicator. It can tell the health and the state of the economy. And that's why it's very, very imperative that we track these things. And I think the future should be around, being able to measure, these interest rates moving forward. And I think that can inform our decision making. So pretty much those are some of the key ideas that we do have. And I also want to speak a bit around how this sort of interest rates called the monetary policy rate is transmitted through the economy. So the central bank actually does report 3 channels of monetary policy. There are many channels, but the central bank does report the exchange rate channel and what I called earlier as the traditional interest rate channel. And I'll be able to just speak how interest rates can seep through the economy and just be able to impact economic growth. So then the other channel is the expectations channel, okay, which is very interesting channel, and I think I'll be able to discuss that. And it is a little bit cross-cutting. Okay, so talking about the traditional interest rate channel, what happens there is that when there is an increase in money supply, the expectation is that interest rates should fall. But it's not always the case, okay, because it also depends on the other factors that influence, interest rates. Like in our country, say that interest rate has many factors. It's not just the policy rate that will influence it. And by the way, we have the policy rate representing less than 30% in the computation of interest rate, while the strength from the commercial bank is over 75%. What does that mean? It means that control in terms of interest rates, specifically lending rates, are actually coming from the suppliers of money themselves, and those are the financial institution. So pretty much those are some of the issues. Now going forward, hoping that our technical people are working on the phone lines, but we just continue. All right, so pretty much I was saying interest rate. Now we move to exchange rate channel. How does this channel play out? So it plays out in the sense that if there is an increase in money supply, for example, that's expansionary policy that the central bank will be pursuing. So we expect that interest rates will be lower. Now, if interest rates are lower, what does that mean? It becomes a disincentive for suppliers of money or for savers. So they will not push in money. They may look at other jurisdictions where it's lucrative to actually invest. So if we have some in this country, which is the case, they actually draw these resources and take them elsewhere in other countries. But at the point of taking that money elsewhere, what is happening? They are going away with the dollar, not the kwacha. The kwacha remains here. And when you dump the kwacha like that, looking at just basic demand and supply, the kwacha becomes weak, and that's what you see. And that's how come, on the other hand, when the central bank would like to strengthen the currency, they speak around reduction in money supply, and that reduction speaks around high interest rates that are actually set. So the idea there is to push interest rates as high as possible, so that it becomes an incentive for those people not to move monies from this country, and also to have an addition of people coming into the country to bring forex. They don't come with kwacha. There's no kwacha out there. Kwacha is in Zambia. So when they come, they bring in forex. And when they bring in forex, what does that mean? Basic demand and supply. You find that there's too much demand for the kwacha. And when there's too much demand for the kwacha is seen to appreciate. So pretty much that's what happens. But when we talk about the expectation channel, which is the third channel that the central bank uses, this one is very interesting because it works around sentiments, okay? And it speaks also around, like I said, it's a little bit cross-cutting because it also does touch issues of exchange rate. And you've seen if people are making an expectation of what should be in a particular what should be in a particular setup, let's say the foreign exchange market, okay? So I think there's a call that we can take on here, all right? Hello, you're through to the program?
Hello, good evening.
Good evening, how are you? Your name, please, and where are you calling us from?
This is Shula from Mbala.
Yes, Mr. Shula from Mbala.
No, the line is not good, man.
Okay.
Hello.
Hello, I can hear you. Kindly speak up, sir.
Yeah, I'm trying to question my son who is on the screen here.
Okay.
We talking of the interest rate.
Yes, sir.
Now, as we are doing business,
Yes, sir.
looking at the economy which is so crumbling in the country.
Yes, sir.
If we invest our money into the bank, what benefit are we going to have? Because long time ago, when we were students, our fathers used to bank money, to invest money into banks in order to gain from the interest rate. But now with this economy, what advantage, what counsel can you give us? Invest into the bank or to keep the money into our houses? That is my question.
All right, sir. Thank you so much. Okay, so I will answer that question. All right, so pretty much that's very, very good question, and I think we need to make it very clear, okay, around interest rates. Yes, it is true, and I do agree that a long time ago our parents would talk about investing in a bank because interest rates were more lucrative. But today the situation is different. And in terms of the advice we could give is that I think this advice is not just on individual basis, but also to government, because the government is supposed to continuously ensure a level playing field for investors or for businesses like you, sir. So what plays out there is if inflation is very high in the country, it means that your returns on your investment in the fixed deposit accounts or savings account are actually swallowed, okay? So we have interest rates in this country playing around 35% annual rate for some institutions. And inflation, in the country is currently at, as recorded of April, 22.7. So now, when we talk about 35% rates, those are lending rates. And that's the rate that the bank will get. But when the bank is paying you, the highest rate you will get, okay, if you're mostly a prime borrower, is that you get around 19.5. Okay, so what you should be able to compare is what is the inflation rate, the annual inflation rate, and the return or the interest that you get from the bank also annually. So clearly, sir, it is very difficult to make money through a fixed deposit account unless you have a good deal and you're coming in as a prime, borrower. So in terms of advice, okay, this is not a professional investment advice, but just to help out. There are many other opportunities and avenues through which you can invest. Currently, the Bank of Zambia has endorsed Okay, of course, working around how to regulate village banks. So I think village banks are also helping. It's an informal setup, and I think it's a good way to actually keep your money than just keeping your money at home. That would not be a good idea because you can lose it to thieves and so forth. But then I would also like to encourage you, you may want to look at government securities market. The government securities market is actually very, very good and lucrative market because you just need a minimum of 1,000 to invest. So pretty much, again, that could be an opportunity for you to just keep money, unlike just keeping your money at home because it will lose value. So pretty much those are some of the options I can give through. Okay, if you want to get in touch with us, our number is 07642 Hello, you're through to the program.
Okay, nothing to pick, but we have no power, but loving it.
Okay.
All right. Raphael from Solwezi.
Raphael from Solwezi.
Yes.
Come through, sir.
Oh, okay.
Okay, we have lost the caller. If you want to call us, the number is 0764250055. So we are discussing interest rates, demystifying interest rates. What are the different interest rates? So you can ask your question around, maybe an experience you've had with a bank in terms of interest rates. Maybe you got surprised that interest rates increased at some particular point. We'll be able to just answer those questions. If you're looking for investment opportunities and where to invest, again, whether it's in a bank, we'll tell you whether you should come through to invest or not. So basically, that's the section that we are dealing with here in terms of demystifying interest rates. But just to go on, I was on a piece on expectation channels of monetary policy, the third channel that the central bank actually uses. So I just want to emphasize this one. There are those people who actually buy dollar. So they buy a lot of dollar in the quest that the kwacha will depreciate. That's also a business, and that's a speculation aspect that actually happens in the economy. But when you speculate in the economy, it has serious repercussions or influences on the overall economy because people start making decisions. And when people make decisions in the economy, it means that the economy is also up and running. So pretty much that's why the Central Bank of Zambia does take care of that. But just to speak and to intensify, we do have other channels which I mentioned, and I think for probably future programs we may discuss. I just want to mention them, that we have the asset price channel, which is also a transmission channel through which monetary policy could be effected. And just at this point, maybe I should take advantage of what the Center for Trade Policy and Development has been projecting around what we expect to be the interest rate or the policy rate that the central bank governor will be announcing on Wednesday. So pretty much the last time we saw a movement to 8.5% in terms of what is the monetary policy rate. It was initially at 8%. Now, what was the idea around that? The idea was that because inflation was too high and the government needed to contain it, so the best they did was to increase interest rates. So just now, the current situation is that interest rates have only dropped from the last time reported from 22.8, they've dropped as of April to 22.7, a slight change. Okay, we may not clearly attribute it to the monetary policy effect, but the idea is that interest rates still remain high in the country, and the expectation from the Center for Trade Policy and Development is that it's I think commendable for or we would like to commend the central bank to maintain the policy rate at 8.5 because we still need the full effect of the decision that was made in the last quarter to take course, because the way monetary policy works is that sometimes it takes up to a year for it to actually seep through the entire economy for you to see a benefit. So you won't sort of just that pumping up or increasing. But if there is any adjustment, definitely we expect that the movement would be upwards because interest rates are very high. And also would like to advise that given the situation, I think for the most part fiscal policy has probably lagged behind in terms of supporting the monetary policy. Oh, by the way, fiscal policy is a side where the government influences both revenue in terms of taxes or debt and expenditure in terms of what they spend. So all that has an influence also in inflation or in terms of aggregate demand that is created. So in trying to craft a policy that would work to ensure that this sort of interest rate we apply works, we also need a mix in terms of the fiscal side, because most of the issues, as noted by the Center for Trade Policy and Development, around the challenges to inflation are supply side driven, and if they're supply side driven, the best and most a good approach would be to look at it from the fiscal side in terms of adjustment. So pretty much those are our expectations. But in case you want to actually get through to those details, you can actually get information from the Center for Trade Policy and Development. Okay, so we still have some minutes, so if you have any caller on the line, please come through. The number that you can call us is displayed on the screen. Okay, so I guess the message was very clear, and that probably people are not able to get through. But all in all, what we can say is that you are through to the Center for Trade Policy and Development. You can actually contact us on our Facebook page, where a lot of information is actually displayed around issues to do with macroeconomic issues. In this case, we were discussing interest rates. So if you have any specific questions around interest rates, it would be very, very imperative that you actually do engage us. So all in all, I think in terms of the advice we could give, table out, it's around what the government should do to ensure that interest rates actually remain sound and favorable for our Yes, sir, you are through to the program.
Oh, yes, sir. I just want to say I like the program. I've just discovered that the program, there's such a program.
Thank you.
On Movie TV.
Thank you very much, sir.
Yes. And then you're doing a very good job.
Thank you.
I've seen you give us a lot of economic data, which I usually actually look for. I just wanted to find out if you can elaborate on, I just joined the discussion. How do you elaborate on the mandate of the Bank of Zambia? What are their mandates? Because I'm not very clear, and I've gone to their website, I'm still not very, very clear. So I was hoping maybe you might help on that front. And then also, if you can discuss the relationship between the current economic situation in terms of interest rates and unemployment and employment itself.
Okay, is that all, sir?
Yes, that's all.
All right, thank you very much for those questions. So on account of time, I'll try to be very quick. So the mandate of the Bank of Zambia is actually to ensure price stability in the economy. So price stability to ensure that there is a stable currency that is running in the economy. So it's to ensure that they are able to adjust money supply as well in the economy, being able to adjust interest rates for you so that we can play the business game that we have to do to make our money. And that speaks to the second question that you have actually highlighted. In this current economic situation, what's the relationship between interest rates and unemployment, for example? So basically what it is that if interest rates are very high, it means that there is a disincentive for people to invest. And if these people don't invest, they will not employ anyone. It's clear. Because for you to invest, you're sort of, for businesses, creating or increasing productivity in the country. And if you increase productivity in the country, you cannot just increase without also increasing the other factor inputs, in this case, labor. So labor speaks to employment. So clearly these variables will speak to each other. And so there is a relationship. In the event that interest rates are very high in an economy, you tend to find also problems around employment, because it's difficult to actually get people to work here in terms of employment. Okay, I hope I've been able to answer your questions. But like I said, for more going forward, you are through to the Center for Trade Policy and Development. You can join us on our Facebook page and get as much information as possible. And now we have come to the end of our program for today. And I just want to thank you for having tuned in. And look out for the other TV unscripted program from the Center for Trade Policy next week, as a discussion on extractive sector will take place. I was your host and presenter for the day, and my name's Boyd Mlair, Head of Research at the Center for Trade Policy and Development. Good evening.